Taking advantage of the ability to invest our money before paying taxes on it is absolutely genius. It allows us to invest more of our own money and do it earlier on than we would have been able to otherwise. And because of the miracle of compounding interest, that means our money could grow to exponential levels by the time we reach retirement. The only issue with this strategy, and it is a minor one mind you, is that the government puts limits on how much money we're able to invest pre-tax every year. Now, like I said, it is a minor issue because, after all, big picture, it's great that we have the ability to do it at all. Not everybody does. But wouldn't it be nice if we could do it a little more? Or if we just had more options than the IRA or individual retirement account and the possible 401k if the company we're working for has one? I certainly think so. And thankfully, there are at least a few options that are actually out there for us that not enough people are taking advantage of. Today, I'm going to be discussing why I consider the HSA, or the Health Savings Account, to be one of the most underrated retirement superweapons. Hey everyone, Daniel here, and welcome to Next Level Life, a channel where you can learn all about investing, debt, retirement, and many other financial topics besides, because let's face it, the schools aren't going to teach it for us. So if any of those topics sound interesting to you, or if you want to learn how to better handle your money and have more financial freedom, be sure to hit that subscribe button and the bell next to my name to be notified every time I upload a new video. And if you want to further support the growth of this channel, you can check out some of the links I've left down in the description below, which includes a 30-day free trial of Audible and 2 free audiobooks of your choice, as well as a list of some books that I would recommend checking out with your free trial. Or you can share this video with a friend and leave a comment down below letting me know what topics you'd like me to cover in future videos. So today we're going to be talking about the HSA, because after reading several articles in Forbes and on the Mad Fientist's blog, among other sources, talking about the HSA as a potential retirement savings vehicle, I felt inspired to make this video and help get the word out there even more. But before I get started, I do feel obligated to point out that this video may not apply to everybody. But for those who are eligible to take advantage of the HSA, in other words, those of you who are on or will be on a high deductible health plan, I believe it might be one of the most underutilized and, dare I say, underrated retirement accounts. So with that in mind, we're going to be talking about the features of the HSA in comparison to a traditional and Roth IRA, as well as how to take advantage of the HSA as a retiree, or even as an early retiree, as well as some potential advantages and pitfalls to keep in mind. Let's get started. So unless you have a 401k where you work, the most common forms of retirement accounts for most people are the traditional and the Roth IRA. The traditional IRA allows you to contribute a certain amount of money each year, $6,000 a year as of the making of this video, before paying taxes on it to fund your future retirement. The money is then taxed when you withdraw it in retirement. And a Roth IRA takes the opposite approach, allowing you to contribute a certain amount of money each year after it has been taxed, again, $6,000 as of this writing, but then that money is allowed to be withdrawn tax-free when you reach retirement. However, one of the biggest fears that many retirees and early retirees alike have that neither of these accounts adequately address, in my opinion, at least directly, is that they won't be able to cover the cost of healthcare when they retire. Healthcare costs, of course, have been rising quite rapidly over the past several years in the form of higher insurance premiums, the cost of doctor visits, or long-term care, so you can understand where hopeful retirees are coming from. That stuff can get quite expensive in worst-case scenarios, and, if not properly planned for, can be budget-breaking even in less than worst-case scenarios. And let's face it, while you could withdraw money from a traditional IRA, you'd get hit with taxes, and depending on when you withdraw it, possibly even a 10% penalty for early withdrawals as well, which would make it less than an ideal move. The Roth is a little bit better since you can at least withdraw your own after-tax contributions to help pay for things without having to pay the 10% penalty imposed on the traditional IRA, but since it was after-tax contributions that initially went into the Roth in the first place, you may be pulling out of a smaller pond than you would have had the money went in pre-tax. And that's not to mention the fact that the money you take out can no longer experience that tax-free growth in the future, which is the biggest draw, of course, to contributing to a Roth IRA, or Roth anything for that matter. In this regard, the HSA is probably the best of the 3 options out there to help us prepare for this potential issue, because the HSA allows us to save money pre-tax, it allows it to grow tax-deferred, similar to a traditional IRA, and it allows us to take it out without paying taxes if the money is for a qualifying medical expense, which is similar treatment to a Roth IRA tax-wise. So it has a potential triple tax benefit by allowing you to save and spend without paying any taxes whatsoever. Again, assuming it's for qualifying medical expenses. In other words, you basically get the best parts of the traditional and the Roth IRAs in one account. However, as sweet as that is, and it is pretty awesome, that on its own would not put it in the class of potentially being the most underutilized or underrated retirement asset in my book. No, the thing that some people I think miss that puts it at that level for me is the fact that you don't necessarily have to withdraw the money for medical expenses when you pay them, or potentially even at all. Let me explain. Say, for example, John starts investing as much as he can into an HSA account this year. The maximum contribution he can put into an HSA account every year as of this writing is $3,500 per year, assuming you're an individual under the age of 55. If you're over the age of 55, it's actually $4,500 per year, thanks to the $1,000 catch-up contribution, and families can contribute even more, up to $7,000 per year as of this writing. For the sake of this example, let's say that John is single and 25 years old, meaning that he'd be able to contribute $3,500 per year into his HSA account. And let's assume that he does this for 5 years, earning an average of 8% per year on his investments. That would mean that he would have accumulated a little over $22,000 in his HSA account by the time he was 30. Then, say he has a qualifying medical expense that will cost him $1,000. And if you want to see what qualifies as a medical expense, I've left links to the IRS and HSA Bank websites that go into all that information in the description below. Now, ordinarily, John would take some money out of his HSA account to pay for these medical expenses. After all, that's what the HSA account is supposed to be used for. However, he doesn't actually have to right away. Assuming he has enough money saved, he is allowed to pay for that medical expense out of pocket, just like anyone without an HSA account would do. And in doing so, he would allow himself to let his pre-tax investment in his HSA continue to grow tax-deferred, if not tax-free, again, depending on what he eventually uses the money for. And if you look at the laws surrounding the HSA distributions, there's currently no law saying that you have to directly pay for the qualifying medical expense with the money from your HSA account, as I just said. But there's also not a rule stating how long you can wait to take a distribution for a qualifying medical expense. According to the HSA Bank's website anyway, assuming the medical expense occurred after you opened the HSA account, you could, theoretically, wait years to reimburse yourself for your qualified medical expense, with a tax-free distribution from your HSA account. Though they do note that you will want to keep your receipts handy for your records in case the IRS ever decides to audit you. But in John's case, he could take a distribution from his HSA account and use it to pay for that qualifying $1,000 medical expense with tax-free money as soon as he received the bill. He's got the money in the HSA account, it is a qualifying medical expense, he's allowed to do that. Or he could delay his HSA distribution until he reaches retirement, which depending on when he retires could be years down the line. But since the distribution is to reimburse himself for a qualified medical expense that he can prove was incurred after he already opened his HSA account, that $1,000 would come to him tax-free. Now the other question that'll come up is, well, what if I don't have any qualifying medical expenses? Well, first of all, that's probably the best case scenario, to be honest. If you go all the way to retirement, even if it is an early retirement and you don't have any qualifying medical expenses, that probably means you lived a pretty healthy life to that point. And honestly, that's a heck of a lot more important. But if you are fortunate enough to go all the way to retirement, or whenever you plan to withdraw the money, without having a qualified medical expense, the HSA does eventually effectively turn into a traditional IRA of sorts. Again, according to the HSA Bank's website, under current laws anyway, you would be able to withdraw your money for any purpose, whether medically related or not, after you reach the age of 65. So it's very similar to a traditional IRA, in the sense that you're going to have to pay taxes on the money that you withdraw, assuming it is not for a qualifying medical expense. The main difference at this point between the traditional IRA and the HSA is that you have to wait until the age of 65 instead of 59 and a half in order to withdraw the money from an HSA account, which could be a bit of a drawback if your only retirement savings account is your HSA, but obviously that shouldn't be the case. But the fact that it basically functions as a traditional IRA after you turn 65 is also what makes this a retirement planning superweapon. Let's look back at John's example. He was able to invest $3,500 a year into his HSA. Even if he retired early at 40 years old and stopped contributing at that point, he would end up with over $700,000 by the time he is 65 years old. and therefore able to start using the money in his HSA account as more of a traditional retirement account. That's $700,000 in addition to anything he may have had in an IRA or 401k, as well as whatever he may have had in his taxable accounts, or whatever he may be making through retirement side hustles or other passion projects. The numbers would, of course, continue to be more impressive the later he stopped contributing. If he didn't stop contributing until the age of 50, for instance, either because he worked longer than before or because he had some sort of passive income streams or revenue from side hustles that left him enough money to continue investing in his HSA account, he would end up with over $875,000. And if he continued contributing that $3,500 a year until he reached the age of 65, he would have earned himself nearly $1 million in addition to his other savings. And even if he didn't have anything else at that point, it still might be enough to fund a lean fire lifestyle in retirement from the age 65 and onward. So, if you're already on a high deductible health plan and are eligible for an HSA, I'd suggest looking into it with a tax professional and with your financial advisor. You might be glad you did. And while it might not be for everyone, in other words, don't just switch to a high deductible health plan in order to take advantage of this without looking at the other potential factors, like potential costs of being on such a plan, especially if you regularly incur lots of medical expenses. But even though it may not be for everyone, it can be yet another great tool to have in your financial tool belt. Not to mention the fact that the money in an HSA account can be taken out, again, tax-free for things like Medicare expenses in many cases. So it may well prove to be of use to you way down the road in retirement. But that'll do it for me today. Once again, if you enjoyed this video, be sure to subscribe and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.